Are you planning on retiring abroad? Most of you don't know this, but if you're planning on retiring abroad, you may end up paying more tax living abroad than if you had stayed in Canada. The idea of retiring abroad and out of Canada makes a lot of sense. The costs in Canada, the weather in Canada, a lot of you look to get away, and a lot of you start retirement by, hey, let's spend a month, 2 month, 3 month down south, or let's go to Portugal, or do something like that. But let's get out of Canada where the snow's deep and it's really cold. And I don't blame you, but a lot of you will then transition to, hey, we really like it in Mexico and Portugal, wherever it is that you're planning on going, or maybe not even planning on going, but end up going. And you don't think about the consequences and the financial impact of leaving Canada. When you're on vacation, especially some of these places that you travel to, the cost of living is very low. It's very cheap to stay, get a hotel, even get out there. But a lot of you don't understand that, okay, let's plan on retiring there. And a lot of you we've talked to have picked Portugal. Portugal's been a very popular place. I won't cover that in this video, but they have a lot of preferential tax treatments. It's very, they've made it very enticing to move to Portugal and retire in Portugal. And other countries are following suit as well. But when you leave Canada, there's more to it than just packing up your bags and flying across the world and living in another country. There's assets that you have here. What happens to those assets? It's very important to understand all these nuances before you jump ship and just think, hey, it's cheaper to live there, it's better weather, let's pick up our bags and go. There's things and steps you need to do before, and we're going to cover that through this video. When you leave Canada, or you're looking to leave Canada, most countries will have a tax treaty with Canada, which means that if you pay a bit of tax on income you earn here, you're going to get a credit there, or vice versa. Or part of that treaty might be there's less withholding tax. So if you move to Portugal, let's say, the withholding tax might be cut from 25% to 15%. Typically, withholding tax will be between 5, it can be as low as 0, but typically 5 up to 25 to 30%, which means that if you leave Canada and retire abroad, any Canadian sourced income, this could be CPP or OAS, pension, rental income, business income, any type of income that's generated in Canada will be taxed in Canada. Now, if you're a non-resident living abroad, there's going to be a flat withholding tax on that income. And this is where the problem lies, and that you may pay more tax than you would if you just stayed in Canada. And we put together plans for clients abroad, and this is the case. They're paying more tax living outside Canada than if they had stayed here. Now, sure, they pay a bit more tax, but obviously their cost of living wherever they went is much lower. So I get it. You might push back and say, yeah, but Adam, yeah, I'm paying a bit more tax, but overall, more money is coming back into my pocket, less into taxes and living and all that, which I totally get. But there's that piece of it, that tax piece. And I know a lot of you leave Canada to give CRA and our government less tax. And the reality is when you leave Canada, a lot of you are actually giving our government more tax than you would have otherwise. Now, again, you have more to spend because it can just go further in the country that you're living in, but you are paying more tax, so just be aware of that. Now, a couple other key points here, and a lot of you don't understand how this works because you've never gone through the process. So I want to share this with you and help kind of educate you before you just jump ship out of Canada. One of the big issues if you leave Canada is what happens with your investments here. A lot of you will have a TFSA account, an RSP, maybe a RIF, a LIR, a pension. You have a bunch of assets. Now, any of these assets that you hold maybe at a bank or a financial institution, a lot of financial institutions are no longer holding foreign assets. So if you're a non-resident of Canada, your financial institution may no longer work with you. And not only that, they may no longer hold your assets, and they may force your assets elsewhere. So these are the small nuances that you need to figure out. Obviously, if you've built up a big RSP here and when you retire abroad, you're still relying on that RSP or RIF income to live off of, you need to make sure you have a financial home for that asset here. And we've had a lot of clients move to BCV, which is a firm that I personally use and we use for a lot of our clients, BCV Asset Management, because they will actually hold foreign assets. And there's other firms, BCV is not the only one, but you need to find a firm that will actually not just hold your assets, but manage your assets for you while you're abroad. Like if markets change and things change, you want your portfolio manager to make changes as well. The other big factor you need to think about is exit tax. And if you're thinking about leaving Canada and you don't know everything about exit tax, you need to sit down and do your homework. Now, exit tax is pretty much when you leave Canada, it's basically a deemed disposition of everything you own other than registered investments, RSP, say whatnot. But your home, any non-registered accounts, if you have businesses, like it can get very complicated and it can get very expensive depending on your life and world and all of that. So make sure you understand exit tax and the timing around everything. Like when you sell stuff, don't leave Canada and sell your principal residence after. Like there's steps to take. And we did a great video with one of the partners at Avisar Chartered Professional Accountants, and we'll link that video up above here. You can watch that video. Hopefully that will help you out. But if you haven't already watched that video, it talks about like emigrating from Canada, what the steps are, what the tax consequences are. So if you're thinking about that, make sure you watch that video. Going back to my original comment at the start of this video about you might end up paying more tax than if you just stayed in Canada. And let me explain this. And I'm going to use an actual example of a client. And we have multiple examples of this that have come through my office in the last year. But I want to give you an example of a client that moved to Mexico. So this client moved down to Mexico, retired there, became a non-resident of Canada. Now, this client has assets up here in Canada. So they have a RIF account, they have CPP OAS coming in, and they have a small pension. When they left Canada, went to Mexico, what happens is that is Canadian source income, those four sources of income: RIF, pension, CPP, and OAS. There is a 25% withholding tax on all of those income sources. So their only income is coming from Canada, but there's a 25% withholding tax on that income, meaning that they're paying a 25% tax rate on all of those assets. Now, if they had stayed in Canada, we ran the numbers, and the tax rate would have been, the average tax rate would have been much lower. For this client, they ended up paying about $4,000 more every year for taxes alone. And that was about 10 to 15% of their overall income. So it was a large percentage of their income that they were paying in extra tax. Now, again, when you have withholding tax in Canada, let's say it's 25%, let's say it's $10,000 a year. If you even file your taxes, let's say in Mexico, you'll get a tax credit for what you've paid in Canada. So you won't owe anything in Mexico, and you don't get a refund. It's withholding tax. You don't get a refund here in Canada. There's no reason to refund that. So what happens is you end up paying the higher of the taxes. If you made a bunch of money in Mexico and your tax bill was much higher, you'd get a credit for what you pay in Canada and pay the remainder down in Mexico. So that's like at a high level, that's how the taxes work. So if a lot of your income is coming from a Canadian source income, and there's, let's say, a 25% withholding tax, and that's a tax treaty with that country that you're moving to, be aware of that. You're going to pay more tax than if you had stayed in Canada. Now, this client, of course, they said, yeah, but Adam, I'm paying a bit more tax, but as long as I, stay in Mexico here, it's much cheaper. I bought a house for much cheaper. Standard of living is much, everything's just that much cheaper. My money goes that much further, which I can't disagree with it. Absolutely. But this client was not aware that they would actually pay more tax living abroad than if they had stayed in Canada. And I think that's a lot of you. So be aware of tax treaties. Again, the Mexico-Canada tax treaty, depending on where you read it, how you interpret it, should be down to 15% on some income, 25% on some. But again, most of the time, and this is what we see, so if you have a different experience, leave that comment below. But all of our clients that we've dealt with in Mexico, they experience a 25% withholding tax on all of their source income in Canada. Now again, every country is going to be a little bit different, but this might be something you want to look into as you dive into which country should I move to? Which country should I retire in? What's the cost of living? What's the tax treaty? How much withholding tax is there? There's a lot that goes into it beyond just packing your bags, jumping on a flight, and moving across the world. And the last question that clients always ask us is, Adam, if I retire abroad, am I going to collect CPP and OAS still? Do those go away, or am I able to collect them? And we've done a full video on that, and we'll link that here.